Elbit Systems beat consensus estimates on both the top and bottom lines for their Q2 2026 earnings report. Top-line revenue came in at $2.29 billion.
Yeah, which is a really solid 15.9% year-over-year increase.
Right, and that easily beat the $2.22 billion Wall Street consensus.
Yeah.
Plus, on the bottom line, non-GAAP EPS was $4.14, completely crushing the $3.24 consensus estimate.
Oh, absolutely. And GAAP EPS also came in strong at $3.61.
It is a massive beat across the board.
And, the forward-looking metrics they reported are just as robust. The order backlog swelled by 34% to a massive, record-breaking $32.0 billion.
$32 billion. That is just staggering.
It really is. And management also reiterated their guidance of mid-teens revenue growth for the full year, which, perfectly aligns with the analyst consensus projections. Those are sitting right around $9.14 billion for 2026.
So imagine posting record-shattering revenue, boasting a massive $32 billion backlog, and then watching your stock plummet 10% before breakfast.
Yeah, it was a brutal morning.
Because that is exactly what happened to Elbit Systems today. Despite the double beat, shares dropped from the 840s all the way down to the $760 to $780 range in early trading.
Just a huge sudden sell-off.
Right. So we're looking at their Q2 earnings reports, the analyst notes, and the broader market reactions to figure out our mission for today's deep dive. Why does a defense contractor posting record demand and flawless headline numbers trigger a mass exodus of investors? Let's unpack this.
Well, it really comes down to market mechanics and a very specific set of structural headwinds. If you are looking at your portfolio today and wondering what happened, you really have to look at how the stock was priced heading into this report.
Because it was basically priced for perfection, right?
Exactly. Wall Street analysts generally maintained a consensus hold rating on Elbit, with an average price target sitting right around $803 to $846. The market had essentially already priced in a flawless quarter.
Meaning there was absolutely no margin for error.
Precisely. At those valuation levels, investors leave absolutely no room for operational friction. You price a stock for perfect execution and, well, the moment you see any potential headwinds in the fine print, institutional capital just starts heading for the exits to lock in gains.
Yeah, a classic sell the news event.
Exactly. Even if top-line revenue is fantastic.
It's kind of like a restaurant that just got 3 Michelin stars and has a wait list a year long, but half their kitchen staff just walked out.
That is a great way to look at it.
The massive demand is completely irrelevant if you can't actually plate the food and get it to the dining room. So are investors looking at this $32 billion backlog and suddenly worrying about Elbit's actual physical capacity to fulfill these orders?
The restaurant analogy works perfectly, but let's take it a step further, because this isn't just standard operational friction, right? It is a structural execution risk tied directly to the nature of their business.
Right, because of where they are located.
Yeah. The very geopolitical conflicts driving this massive demand, so the ongoing hostilities in Gaza, Lebanon, and the broader tensions with Iran, those are simultaneously causing severe disruptions for Elbit's operations.
The company explicitly retorted ongoing supply chain bottlenecks, right?
Yes, and elevated transportation costs. But, the most unique friction point here is the reserve duty call-ups for their own workforce.
Right, because we're talking about an Israeli defense contractor in the middle of a prolonged regional conflict. But how exactly does that impact a highly automated manufacturing floor? I mean, can't they just hire temporary workers to fill the gaps?
Not in this industry, no. Building advanced defense technology, whether it's avionics, electronic warfare systems, precision munitions, it all requires highly specialized, cleared technicians and engineers.
Oh, right. Security clearances.
Exactly. You cannot simply pull temp labor off the street to assemble high-power lasers or calibrate surveillance drones. When skilled workers from your production lines are called to the front lines for military reserve duty, it inherently throttles your manufacturing output.
Wow, so it literally slows down the velocity at which they can convert that $32 billion backlog into actual recognized revenue.
Yeah, exactly. And on top of that, management noted attacks on some of their facilities, adding a whole layer of physical security friction to the entire operation.
So the geopolitical situation acts as this intense amplifier. I mean, it drives the top line through the roof because global defense spending is surging, but it severely strains the actual operations on the ground.
It is a double-edged sword, for sure.
But reading through the analyst notes, that operational strain wasn't the only thing spooking investors today. We need to talk about the tax hit because it looked massive on paper.
Oh, it was massive. And this is really the second major headwind that caused the valuation multiple to compress today. We are talking about the new OECD Pillar 2 global minimum tax rules.
Right, I saw that mentioned.
Yeah, because of this new framework, Elbit's effective tax rate skyrocketed. Just to give you the exact numbers, in the second quarter of last year, their tax rate was just 5.6%.
Which translated to what, about $7.1 million?
Exactly. But this quarter, under the new OECD rules, that rate jumped to 16.4%, or roughly $32.7 million.
A jump from 5% to 16% in a single year is jarring. But what exactly is the OECD Pillar 2, and, why is it specifically targeting Elbit right now? Did their internal tax strategy fail?
Well, their strategy didn't fail. It's just that the rules of the global financial game completely changed. The OECD basically implemented Pillar 2 to establish a global minimum corporate tax rate of 15% for large multinational enterprises.
Okay, so it sets a floor.
Exactly. Historically, multinational companies, and that includes defense contractors, they could optimize their tax burdens by operating across different global jurisdictions with lower tax rates.
Right, the classic corporate loophole.
Yeah, and Pillar 2 essentially puts a hard floor under that practice. If a company pays less than 15% in a specific jurisdiction, a top-up tax is applied just to reach that minimum threshold.
So because Elbit is a massive global enterprise, they're now caught in this 15% net regardless of where they actually manufacture or sell.
Yes. And what is critical for you to understand as an investor is that this is not a one-time charge, right? It's not a temporary penalty.
It's a structural shift.
Exactly. This is a permanent structural change to how their earnings will be taxed moving forward. It permanently pressures their net income margins.
Which hits the valuation models directly.
Right. When Wall Street analysts build their discounted cash flow models, to value a stock, a permanently higher tax rate directly reduces future cash flow projections.
And when future cash flows drop, the valuation multiple investors are willing to pay today naturally compresses.
Exactly. That tax reality, combined with the capacity constraints, well, that is the exact formula for a 10% stock drop.
So on one hand, we have record global demand. But on the other, we have severe capacity constraints, a drafted workforce, and permanent margin pressure from these global tax changes.
It is a lot for management to juggle.
Yeah, so to see how they are surviving this friction, we can't just look at the headline numbers. We really have to look under the hood at exactly where the money is coming from.
Oh, definitely.
And if we look at the segment performance, it turns out the traditional battlefield is actually shifting.
It is a profound shift. The data from this quarter paints a very clear picture of modern warfare priorities. Let's look at the land systems segment first.
Right, this was their biggest growth engine.
Yes, it surged 32.1% year over year to $770.2 million.
And that makes intuitive sense given the headlines. I mean, that surge is heavily driven by traditional kinetic warfare, specifically massive ammunition and munition replenishment for the Israel Ministry of Defense, correct?
Correct. When prolonged ground conflicts occur, the burn rate for traditional munitions is just staggering. But while land systems represents the immediate kinetic needs, the other growth segments, they represent the future of defense tech.
Like the ISTAR and EW segment.
Yeah. That stands for intelligence, surveillance, target acquisition, reconnaissance, and electronic warfare. That segment grew 21.9% to $447.8 million.
And here is where it gets really interesting to me. The notes specifically highlight high-power lasers and maritime demand in the Asia-Pacific region as the fuel for that ISTAR growth. Why are lasers suddenly becoming such a massive revenue driver?
It really comes down to the economics of modern air defense. Right now, militaries around the world are using interceptor missiles that cost millions of dollars each to shoot down adversarial drones that, might only cost a few $1,000s to build.
Oh, wow. Yeah, that math just doesn't work out.
It is a completely unsustainable cost-exchange ratio. High-power lasers fundamentally change that math. Once the system is actually built, the cost per shot is essentially just the cost of the electricity to fire the laser.
That is incredible.
It is. That is why demand in this segment is surging. Nations are just desperate for cost-effective defense against drone swarms.
That makes perfect sense. The economics of warfare dictate the procurement. Moving down the list, Elbit Systems of America, or ESA, jumped 16.5% to $476.8 million.
Yeah, management called out advanced night vision contracts there.
Right, and a massive $370+ million award from U.S. Customs and Border Protection. And then we have the C4I and Cyber segment, which grew 11.5% to $252.9 million. For anyone not deeply embedded in defense jargon, what exactly does C4I do?
C4I stands for Command, Control, Communications, Computers, and Intelligence. If land systems are the muscle of the military, C4I is basically the central nervous system.
Okay, that is a good analogy.
Imagine you have a surveillance drone in the sky, a tank on the ground, and a naval vessel at sea. C4I represents the highly secure network infrastructure, the software, and the communication arrays that allow all those disparate platforms to share targeting data in real time.
Wow, so as militaries become more digitized, this segment basically becomes the invisible glue holding the entire operation together.
Exactly.
So we have land systems booming for immediate munitions, ISTAR surging on next-gen laser economics, ESA winning border security contracts, and C4I digitizing the battlefield. Every single one of those segments is firing double-digit growth.
Right, but looking at the data, there's a glaring anomaly.
Yeah, what exactly happened to aerospace?
Aerospace was the definitive weak spot this quarter. Revenues actually declined by 8%, dropping to $495 million, and completely missing the $526 million consensus estimate.
Why the big miss?
Well, management attributed this contraction to two primary factors: an unfavorable project mix and lower training and simulation sales in Europe.
Let's break that down. When a defense contractor blames an unfavorable project mix, what does that actually mean in plain English?
So defense contracts are long-term, multi-year agreements that move through distinct phases. You start with research and design, and you move into prototyping, then low-rate initial production, and finally full-rate mature production.
And the margins change across those phases, I assume.
Exactly. The profit margins and the revenue recognition are much lower in those early phases because the company is absorbing high upfront engineering costs.
Oh, I see.
So, an unfavorable project mix simply means that the specific aerospace contracts that cross the accounting threshold to be recognized as revenue this quarter, they just happen to be clustered in those earlier, lower margin, lower value phases.
Got it. It's essentially just a timing issue regarding where their current contracts sit in the life cycle.
Pretty much, yeah.
But what about the European side? You mentioned European training and simulation sales dragged down the aerospace numbers. With a major war happening on the European continent right now, why would simulation sales be dropping?
Well, while management didn't explicitly detail the sovereign budgets, we can deduce the mechanics of defense procurement here. Training and simulation platforms are generally long-term readiness investments.
Right, they aren't for the immediate battlefield.
Exactly. When a continent is facing immediate physical conflict on its borders, defense budgets rapidly pivot away from long-term simulation centers and toward immediate kinetic procurement.
Like the munitions, drones, electronic warfare we talked about.
Yes. Nations are prioritizing immediate battlefield utility over classroom readiness. Elbit did see higher unmanned aerial vehicle, or UAV, sales in Israel, which helped offset those European simulation declines slightly.
But clearly not enough to prevent the overall 8% contraction in the aerospace segment.
Unfortunately not, no.
That geographic shift is fascinating, though. You have European simulation sales dragging down aerospace, while at the exact same time, Asia-Pacific maritime demand is boosting electronic warfare. It really highlights how globally dispersed their operations are.
It does, and that geographic revenue split is a critical component of Elbit's risk mitigation strategy. I mean, yes, they are fundamentally an Israeli defense contractor, but they really operate as a globally diversified entity.
What was the exact breakdown this quarter?
In Q2, Europe actually contributed 25% of total revenues, North America contributed 20%, and the Asia-Pacific region contributed 14%. Israel made up 37%.
Largely due to that immediate ammunition replenishment we discussed earlier.
Right. But the most important metric for you to monitor is the backlog. When you look at that record $32 billion order backlog, 73% of it comes from outside of Israel.
Wow. So the demand is fully globalized, which basically insulates them from being overly dependent on a single government's defense budget.
Exactly.
So what does this all mean for the company's financial health? I mean, having established this massive global demand and the serious capacity and tax headwinds constraining it, how is management actually navigating their profitability?
It's a great question.
Because despite the tax hits and the supply chain hurdles we talked about in segment 1, they still managed to expand their margins this quarter.
They did, and it is a real testament to the mechanics of operational leverage.
How so?
Well, when a manufacturing company pushes a significantly higher volume of product through its existing factory footprint, its fixed costs, the rent, the basic utilities, the core administrative salaries. Those are distributed over a much wider revenue base.
Ah, I see.
This naturally expands the profit margin on each unit sold, even if variable costs like shipping have actually gone up.
And we see that clearly in the numbers. Non-GAAP gross margin expanded to 25.6%, up from 24.4% a year ago. Non-GAAP operating margin hit 10.4%, up from 8.9%.
Management specifically noted on the earnings call that these margins actually surpassed their own internal targets.
And they backed up those percentages with hard cash, too. Operating cash flow for the first half of 2026 was a very robust $517.8 million, compared to just $304 million in the same period last year.
That cash flow metric is essential for investors. It proves they aren't just booking theoretical revenue on a ledger.
Right.
They are successfully delivering products, collecting on those invoices, and turning that backlog into liquid capital despite all the execution challenges they face.
But here's the multi-billion-dollar question. They have the cash, sure, but scaling physical operations right now with a drafted workforce and broken supply chains is incredibly difficult.
Oh, absolutely.
It's like trying to upgrade a car's engine while it's speeding down the highway. How exactly does CEO Butsi Maklis plan to deploy this capital to actually build and deliver $32 billion worth of defense tech?
This was the major focal point of management's commentary. They are attacking the physical capacity problem with very, very aggressive capital allocation.
Okay, what's the first step?
First, on the innovation side, R&D spending rose to $159.1 million, which represents about 7% of their total revenue.
And didn't they get a significant regulatory tailwind on that R&D spending?
They did. They recognized a cumulative year-to-date impact of approximately $40 million after applying Israel's new law for the encouragement of industry.
Which provides targeted incentives for research and development, right?
Exactly. But more importantly, for the immediate capacity bottleneck, management has aggressively bumped their internally funded capital investments, their CapEx, to roughly $300 million.
$300 million. Where exactly is all that money going? Are they just building bigger warehouses?
No, they are completely modernizing the production lines. That capital is going directly into expanding their physical manufacturing footprint, deeply integrating robotics, and deploying artificial intelligence into the assembly processes.
And that ties right back to the execution risk we discussed earlier.
Exactly. If you are struggling with workforce availability because your highly skilled technicians are continually called up for reserve military duty, automating your production lines with robotics is really the only logical countermeasure.
Right. Robots don't get drafted.
Precisely. By automating the repetitive, high-precision tasks like component assembly, you free up your remaining human workforce to focus entirely on complex systems integration.
That makes a lot of sense.
Management also noted that a major new, highly automated facility in southern Israel is now fully operational and rapidly ramping up output.
I also noticed in the analyst notes that clients are actually beginning to co-fund these capacity expansions. That stood out to me.
Yeah, that is perhaps the strongest indicator of just how desperate the global customer base is for these specific systems.
Sovereign clients are actually paying for the factories.
Yes. They are not just placing orders. They are willing to match Elbit's CapEx spending or even finance entire new facilities tied to technology transfer agreements just to ensure they secure their supply chains and get their orders on time.
Wow. It is a shared global investment in expanding Elbit's output.
It really is.
And while they are pouring capital into R&D and automated factories, they aren't ignoring the income investors either. The board declared a $1 per share quarterly dividend payable on October 26, 2026.
Albeit subject to a 16.8% withholding tax.
Right. But it keeps the dividend growth narrative intact while they attempt to scale.
Definitely. If we pull all of these moving parts together for the retail investor who's just looking at this 10% drop, it leaves you with a very clear, critical concept to monitor moving forward.
What is the main takeaway?
The demand side of the equation is completely unequivocally secured. 42% of that massive $32 billion backlog is already firmly scheduled for delivery through the remainder of 2026 and 2027.
So the sales team has done their job. The contracts are signed.
Exactly. Which means the ultimate test for Elbit moving forward is no longer about winning contracts or beating out competitors in the bidding phase.
It's all about execution.
Yes, it is a pure execution play. Can their $300 million CapEx push, the robotics, the AI integration, the new co-funded facilities, can all of that actually scale their physical manufacturing capacity faster than global geopolitical friction can disrupt their supply chain?
Tension is everything right now.
It is. That tension between automated capacity expansion and real-world operational friction is exactly what will determine if the stock can break out of its current valuation ceiling and recover from today's sell-off.
It really leaves you with one final, pretty provocative thought to mull over as well.
Oh, yeah.
Yeah. If major defense contractors like Elbit are now relying heavily on artificial intelligence and robotics to replace their drafted human workforce, how long is it until those same automated manufacturing systems are essentially building the automated weapons systems of tomorrow, entirely without human intervention?
Wow. Yeah, the supply chain of modern warfare is becoming just as autonomous as the weapons themselves. It is a wild thought.
That is your Elbit Systems earnings recap. Make sure to follow the show for your daily earnings coverage, keeping you ahead of the market every single day.